Welcome, D-Traders. It's me, Ekaterina Stikhina, and you are watching the first recap of the Asian session in 2023. Most of the world's stock markets were off on a Monday for the winter holidays. Financial markets in Japan and New Zealand are still closed today on January 3. Australian shares are currently trading in a negative territory. Markets are slowly shaking off the festive mood and are getting ready for the business week. Unfortunately, worries and fears of the previous year will stay in the new one and may get even more serious. Apparently, global central banks will continue to raise interest rates to tame soaring inflation, as it's still extremely high and is threatening the economy. The attempts to tame prices may easily tip the world's economy into recession. The US Central Bank, for example, raised its benchmark interest rate 5 times in 2022, and the recent rate hike in December was 0.5%, and the previous four were 0.75%. The US Federal Reserve warned that it might have to keep rates at a higher level for a longer time. The main question now is how long the fight against inflation will last. The predictions are rather disappointing. On January 1, the head of the IMF warned that 2023 may be a tougher year for the global economy than 2022. Firstly, the three big economies, the United States, Europe and China, are slowing down simultaneously. Secondly, global costs are increasing. According to the IMF chief, Kristalina Georgieva, supply chains are being restructured after the pandemic, allowing producers to find the balance between production costs and sustainable business development. Ms. Georgieva predicts that a third of the global economy will be in a recession in 2023, and the US economy, which is more resilient than others, may avoid the damage. At the same time, half of the European countries will inevitably face an economic downturn due to geopolitical conflict in Ukraine. China will also see contraction in its economic growth, the IMF forecasts. Moreover, the dismantling of its ultra-strict zero-COVID policy poses a risk to other global markets, as it may bring a new outburst of the COVID disease across the world. On the other hand, there is a hope that China, the world's second-largest economy, will recover at a faster pace. Amid such disappointing forecasts and ahead of some key economic data, traders prefer to stay out of long positions. Besides, investors expect the release of the Fed meeting minutes this week, which are supposed to give some clues about the balance between hawkish and dovish sentiment of the US Fed members. This is why the US dollar is trading cautiously in the session on Tuesday. The greenback is trapped in a narrow price range between 103.5 and 104 over the last year. The US dollar index, which shows the value of the US currency against 6 other majors, advanced by 8%. And the main driver pushing the dollar up was the Fed and its aggressive rates policy. The dollar started the new year of 2023 on a moderate note and with a slight rise towards the level of 103.90. Trading activity will gradually increase in the course of this week. The greenback is expected to consolidate ahead of the important news such as the Fed minutes and the US labor and economic data. The trajectory of the US dollar against the euro pound and other currencies is more or less predictable. Yet with the Japanese yen, everything is more complicated. In 2022, the yen was an absolute outsider among the G6 currencies and lost 12% trading against the US dollar. However, this year may be a better time for the Japanese currency. The main reason to weaken the yen was an ultra-loose monetary policy pursued by the Bank of Japan. By contrast, the greenback was gaining ground thanks to the Fed's hawkish stance, and this year the Bank of Japan is going to change its monetary policy. In December, the regulator lifted the cap on the 10-year government bond yields, thus giving ground for speculations about a change in the monetary policy. What's more, the term of the dovish governor Haruhiko Kuroda will end in April, so changes may come very soon. The Japanese yen had slightly recovered at the end of the last year. In the Asian session on Tuesday, it retested its high of 129.90 that was last seen in June 2022. Then the yen retreated against the US dollar to end up at 130.90. At the start of the session, the pair managed to break above the psychological level of 130 and test the resistance line at 129.50. Later on, the dollar bulls seized control, and the pair was rising in the price range of 129.50 and 131.40. So the yen continues to depreciate against the US dollar, and this trend is likely to persist in the coming days. With the increase in trading activity during the week, the US dollar may also extend its uptrend. The wait-and-see mode in the stock market suggests that the risk sentiment stays low, and this is especially relevant when mixed news is coming from China, Australia's trading partner. Its market may weaken even more if pressured by new challenges posed by the COVID pandemic. Therefore, the Australian dollar dropped against its American counterpart and spent the session in a negative zone, trading between 0.6698 and 0.6839. The FOMC meeting minutes that are due to be out on Wednesday will be a decisive factor for the pair. Also, the US jobs report on a Friday will determine the pair's trajectory. In the meantime, the Aussie has not received any support, so it's trading with a decline near the level of 0.6714. And this is how the Asian market started the new year. There are some more important events coming ahead. Stay up to date so that you can always benefit from a fresh news. InstaForex team is happy to help you with this. Watch our next videos and leave your comments down below. See you soon!